Walk through any major business district right now, and things look fine. The sidewalks are busy, the cafes are pouring coffee. But inside the actual office towers, entire floors are sitting empty in the morning light. While the broader stock market has pushed right back toward optimism, a massive volume of commercial property debt is quietly approaching maturity. For the better part of the 2010s, investors built an entire financial ecosystem on a specific assumption that borrowing money would cost around 3%, and property valuations would naturally keep rising. To slow down inflation, central banks had to raise those interest rates, but in doing so, they exposed a harsh reality. Many of these commercial real estate models only survived because debt was practically free. The total breakdown of the mathematical equation used to finance the modern urban skyline represents a far greater threat than the bankruptcy of individual landlords. Over the next 2 years, a massive wave of that commercial debt is scheduled to mature. The property owners have to refinance those loans, but they are stepping into a much more expensive borrowing environment. These buildings are highly sensitive. If occupancy falls by 15%, baseline revenue takes a direct hit. Hitting the refinancing wall compounds the problem. Borrowing costs jump from 3 to 7%, doubling interest expenses, and that profit margin completely disappears. The landlords are trapped by this math. They cannot raise rents because the office market is structurally weak, and cutting maintenance costs isn't nearly enough to cover a multi-million-dollar interest shortfall. When a building generates less cash and costs more to finance, its valuation drops. That transfers the financial risk away from the property owner and directly onto the balance sheet of the bank that issued the loan. This is where the problem moves out of the physical buildings and into the banking sector. Regional and mid-sized banks hold a disproportionately large share of these commercial property loans. These are collateral-backed loans, meaning the physical property itself is the primary guarantee supporting the value of the bank's asset. If the borrower stops paying, the bank takes the building. This flowchart illustrates the causality loop. Lower occupancy flows directly into reduced rental income, inherently slashing the property's valuation. Slashed valuations degrade the bank's collateral. Weak collateral makes refinancing harder, forcing distressed sales. Those sales set lower market prices, feeding right back into the loop. Banks do not need a massive wave of outright bankruptcies to feel the pressure. The sheer uncertainty surrounding degraded collateral is enough to force them to aggressively tighten their lending standards. By tightening lending standards, banks transform a localized real estate problem into a systemic reduction in credit creation for the entire economy. The current occupancy drop stems from a structural shift in human behavior, breaking the assumption that office attendance will eventually return to 2019 levels. Look at this line graph comparing expectations versus reality. Many financial projections relied on a sharply rising return to the office, but the stabilized reality is a persistent, flatlined adoption of hybrid work. Reduced demand for office space has become a permanent feature of the market, requiring a corresponding permanent financial adjustment. When banks tighten up, the impact travels from the boardroom down to the ground level. A bank rejecting just a handful of commercial refinancings directly halts cash flow to the local contractors, security firms, and cleaning services maintaining those buildings. As the towers sit half-empty, the lack of daily foot traffic physically starves the surrounding environment. Cafes sell less coffee, retail shops lose customers, and transit systems see fewer riders. Commercial real estate acts as the connective tissue between finance and local economic activity. As its financial health deteriorates, it slowly chokes off the income streams of small enterprises. The tightening of credit triggers second-order effects across major cities. The most immediate is the sudden, quiet halt of new commercial construction projects. That deceleration travels straight down the industrial supply chain. A canceled project means a sudden drop in demand for raw materials like steel, glass, and cement, which quickly translates into hiring slowdowns for logistics and transportation providers. The strain eventually reaches the municipal level. Local governments rely heavily on commercial property taxes to fund critical public services, infrastructure, and transit budgets. This pie chart illustrates the dangerous lag effect at play. Building valuations adjust downward over years, not days. City tax revenues quietly contract, placing severe strain on services and transit without ever causing a single headline-grabbing crash. The true cost of this crisis is a persistent, slow-motion erosion of urban economic vitality. Because the deterioration is gradual, policymakers struggle to stabilize it in real time. This leaves central banks facing an impossible macroeconomic dilemma regarding their interest rate policies. Cutting rates aggressively risks reigniting sticky inflation, but holding those rates high ensures the prolonged suffocation of the commercial property markets. Even if central banks decide to cut rates, cheaper borrowing alone cannot solve the problem. Lower interest expenses do not reverse the structural lack of human demand for office space caused by hybrid work. The financial system cannot wait for a cyclical recovery that is not coming. It has to permanently reprice and restructure its debt to fit an environment that no longer operates on cheap money models. The greatest vulnerabilities in our modern financial networks rarely explode. Instead, the incentives simply stop working the way they used to.